Hi everyone, so 8th of April 2016, welcome back to our series on India Indices FA reviews. We're looking at the FMCG Index. Just want to also put on record that these sessions are pretty collaborative in terms of the fact that the data is being very grateful to Sid for generating this data, and also to Balki for putting up the FA reports together so that we can do a more comprehensive review of the whole sector, as you will see, right? Okay, so with that, what you're looking at now is the FMCG, Nifty FMCG Index, right from 2005 onwards, and this is till date 7th of April 2016. So one of the things definitely about this index is that it's outperformed the overall market by a long shot. 2008-9, the index was at 7,000. 7,000 has gone to 21,000. So the FMCG index has tripled in the 8 years since the 2008-9 crash, or if you take it from the bottom of 5,000, it's gone up almost 4.5 times, 5 times. Right, so that's fantastic outperformance, and ideally that's the sort of stuff that one would like to latch on to as early as possible, if indeed it's possible to really figure that out. Always a challenge to find such things. So quickly doing a technical review of that, you can see that 18,000 is an important level, and right now for the last about 1 year the index has definitely been in a sort of downtrend. I could probably put this line down there just to keep a tab on in the future. Right. So as long as that downtrend is there, technically not a good idea to invest. With the down move that has resumed 2 days back, maybe we'll go down to about 19,000. Right now I would say 18.5 is probably the worst case scenario. Having said that, the usual things about an index testing its old life high levels, and there's so many of those, that's looks completely unlikely right now. So for example, 6,500 or this level of 6,260, which was the 2006, 7, 8 triple top in a sense, has never been tested. But that means, what, we're talking about more than half the value of that index coming down. So we'll just wait and watch for that, and let's see if there's any fundamental justification for that to happen, which is pretty unlikely. So anyhow, technically speaking, we are probably not looking below 18 or 16 worst case scenario at this point. Of course, we'll keep reviewing that. So good idea to probably put an alert for around 18.5 or something. Maybe a good time to enter into the market at that time. Also to invite your attention to volume business. So you can see that it went up here on good volumes, and then now it seems to be coming down on low volumes. So some amount of buying that's definitely going on. Just to add, as on 8th of April, so I don't know, to all those of us in Bangalore, in my area it drizzled about 2 hours yesterday night. It's still drizzling here actually, so good. It's definitely not the monsoons, but I was just reminded of that because we're talking about drought. You've seen the news all over. I don't know if you've been tracking the Bundelkhand drought. About 1.2 or 1.8 million people, it seems, have moved from Bundelkhand, which is somewhere in the middle of Uttar Pradesh area, to Delhi in the last few months. It's all over CNN, IBN. It's the only channel which is running one series on it and all. Maharashtra, you've seen that whole thing with stuff in the High Court and the IPL and PIL stuff around it going around. Of course, in Karnataka, our KRS is almost close to its, what's called the dead capacity or something like that. And if the rains don't come, I think we're looking at big time trouble across the country. So this is in the context of the FMCG thing. In the last few years, one of the reasons FMCG, especially in 2009-10 onwards, boomed is because of rural economy growth. And if the rural economy now sort of stalls or doesn't grow as well because of the drought, then we definitely have a problem on our hands in the next few months at least. And also adding to that, you can think about food inflation, which could pick up again. So on the issue of inflation, you've got both the drought, which can lead to food inflation, and as you know, crude oil prices have been in their 40s now, $40, 35, 40. So from sub 30s, it's now come to 40s, and there's an increasing opinion that the worst might be over for crude. Iran is saying that they will increase crude till they pump out $4 million barrels per day. They are right now at 2 million barrels per day. So whether the rest of OPEC does that or not. So anyhow, digressing, but so if the rural economy doesn't do well, we definitely have a problem coming up. So that's something to keep in mind. The other thing on the FMCG thing I think we should add is both the huge commercial competition and threat that the entrenched FMCG guys are going to face from both Patanjali Ayurveda and Sri Sri Ayurveda. Both of these have massive expansion plans of, and I think Patanjali or Sri Sri, one of them hit 5,000 crore revenue, it seems. There was a news article or TV I read somewhere just last week, and it's just the beginning for them, and they want to massively expand. And since these are obviously charitable slash NGO slash society slash trusts, and they are not commercial enterprises, it'll be interesting to see how they impact the the listed companies and how their growth gets impacted, right? So interesting times ahead and massive new competitive threats ahead for the FMCG space, and that's something to really keep in mind. So the sort of maybe growth that we saw in the earnings of the FMCG companies in the last decade is perhaps not going to happen simply because of the new players that are not small. They're quite large in their own right, and a lot more people seem to be gravitating towards that perhaps, right? If anybody's used any of these products in terms of Patanjali or Sri Sri, then do share your experiences and get a sense of whether these new products, or maybe we should try a toothpaste or try a soap or a shampoo or something, just to get a feel. How does it compare to your entrenched ones, and do you think the market is going to like it? I think that would be a good thing to do, actually. Right? I'm not sure it's available in my local shops right now, but probably should go out and get some stuff. It'll be a good idea be a good experiential way of figuring out, and then maybe give it to your family members and see what they have to say. Okay, so that's one thing to keep in mind. And with that, let's jump into the rest of the analysis. So we've got data only from mid 2011. So certainly that's not enough to tell us our entire past as we would like to. No, so that's something to please keep in mind, that we are restricted by the data that we have. So strictly speaking, this is not a PE band that we can rely on. Somewhere from 27 at the bottom, we've gone all the way to 50, and then 33 seems to be another level, and at the top side maybe somewhere around 39, 40. I'll just leave it at 40. It's a psychological number, nothing else. All right, so this is just a thought for anyone who's looking at doing some more analytics. So we have actually quite a few sectors where we don't have data from 2008-9 onwards. I think particularly for SID, just putting out an thought, SID, maybe, I don't know, we did some brainstorming over doing some sort of a correlation study for EPS and all these ratios versus the Nifty EPS. All right, or I'll give you another example, the private sector bank versus the bank Nifty and the public sector bank index, and I'm talking about the FA ratio, some sort of a correlation study. And if we found some sort of a correlation, which there will be, then we could extrapolate that backwards and extract a sort of tentative data from the Nifty for FMCG going back. It's not the best way to do it, I know, but I'm just putting an idea out for us to explore. Ideally, public sector bank Nifty, private sector bank Nifty correlated with bank Nifty would be great because they're all of the same group. FMCG versus Nifty may not be such a good idea, but just putting out something there to think about how we might be able to get more data if NSE does not generate that data at some point, right? And this is anybody listening to the recording of this, if you've got any thoughts on how we could get reliable back data without having to actually do the number work, do share your ideas with us, right? Thank you. Okay, so PE ratio between 27 and 50, 50 PE 2015 right here, clearly very, very expensive. Another index which is very expensive on the PE side, no doubt about it. What I simply do, by the way, is very quickly look at a PEG thing. So, and then if PEG has to be 1, you're talking about EPS growing at 30-50% per year, and it's clearly not possible once you're already the size of your ITC and HUL and all that stuff. So again, the question comes back to me as to why this sector is being rated so well and having expensive valuations, right? So anyhow, so this is the PE. Looking at the EPS now. So EPS continues to rise nicely, but there was a big drop in EPS in 2015, and that basically explains this big jump in the PE at that time. So basically the price didn't come down, the EPS dropped, right? So that's why this big spike here right in the middle in April 2015 when it went from 35 to 50. That was because the EPS went from 580 to 430, right? So that's what explains this rise in PE. I'm wondering why the EPS fell 580 to 430. That's almost a 20% fall in EPS. That's not a small number, and we definitely need to, I don't know, was there some ITC or HUL? One of those would have declared something exceptional. Anyhow, EPS seems to be on track to come back to its high levels of 590. We are already in the first week of April. Like I said, results should be out pretty soon, annual results, and we will get better updates on that. Okay, so that is our weekly, EPS. Coming to dividend yield, most expensive dividend was, or rather cheapest was at 2.5, and then it fell to 1.1, or actually lower than that. Please remember, again, we don't know how this compares with dividend yield in 2008-9 and all that stuff, and dividend yield is to be understood inversely, right? That's something to keep in mind. And so dividend yield in the range of 1.3 to 1.8, nothing much happening. Interesting that in 2015, when the EPS did this fall, there was no drop in dividend, right? So dividend yield basically very much remained the same. If you look at the dividend itself, the dividend chart, right? So there you have it. So this is the dividend chart you're looking at, and this is April 15. This is not much in terms of, the dividend went from 300 to 270, of 10% fall in dividend, but a 20-25% fall in EPS. So dividend did come down, but really not by any significant amount, right? So that's well, actually there shouldn't be any bans for this. Just one level to keep in mind, and quite possibly dividend is going to go up in the coming quarter. Actually, a little bit of a surprise here because as we all know, with the last budget there was that increase in the dividend tax, and there is no jump in dividend here. I thought some of these companies were declared big fat dividends, and I've seen a jump in dividend. But clearly not seeing that, so wondering why. Okay, so in terms of dividend yield, tough to say whether it is expensive or cheap, but clearly if you just look at the data that we have, the highest dividend yield was 2.5 and the lowest was 1.1. So that's almost half or doubling the expensiveness. So between mid 2011 to 2013, in terms of the index, what has happened is essentially there. So the index was at around 14,000, right? So at this point 14,000 went to 22,000 right on top. That's almost what, 60-70% increase in the price, and with that the dividend yield has come down. Wait, one second. Sorry, I got my dates wrong. Let's put this right. So we've got right. So in this part, right. So just let me move back a bit. Yes. Okay. So just to compare like for like, the index went from 9,000 to 19,000. So that's more than a doubling, right? So the index went from 9,000 to 19,000 between the green and the red line, and that was the time when the dividend yield, fell from, we don't have back data, so fell from 2.5 to 1.1, right? So basically on account of price increase, nothing else, right? Yeah, even at that time, if the dividend did decrease, it will increase from 900 to 1,250. So dividend increased by about what, 200, about 20%, but the stock price went more than double. That's why the dividend yield has drastically come down. So right now at around 1.5, it would be around on par with the dividend yield of the Nifty itself. So can't really say anything about expensive or cheap right now. All right. Okay. Price to book value. So if you look at the whole data, then price to book value, again, these are numbers that I really find honestly quite amazed by them. Price to book value of 14 and a half, 15. This really seems to be, really crazy price to book values. Remember, the price to book value peak for the Nifty was around 5.5, 6.5. 5.5 in around 5 or 5.5 in 2000 and yeah, 2001 dot-com boom, and in the 2008 boom it was 6.5, right? So the overall index Nifty, highest ever PB ratio of 6.5. Here you're talking about 14, 15. You're talking about numbers which, I mean, uh, book value is what? Your assets minus liabilities, hard tangible assets. If you shut down a company, then what would it be? And you're saying we are putting a price of this which is 12 times that shutdown value. The price is trading at that ratio. I mean, is that the worth of the trademarks, the brands, the products that they make? I don't know. Maybe I'm missing something, and I would love anybody to add to this. If you have any, opinions, would certainly like to have a discussion on this. But we have seen about 2-3 sectors like this. Why is the book value, or price to book value rather, at such high levels, right? Why does the market uh, bestow these sort of sectors with such fantastic levels? Is it just it seems irrational to me, honestly. It doesn't make sense, 11x PB, but like I said, could be missing something. On the book value itself, right, it has been consistently increasing since the last mid 2011 till now. No change in that. So it's gone from 900 to almost 1800. So book value has doubled in 4.5, 5 years. That is definitely significant, I would say. A doubling of book value in 4 or 5 years is quite a bit, right? I think it says a lot for the strength and the growth in the sector. And if this growth rate continues, we haven't really paid too much attention to that, but this one has definitely caught my attention. A doubling of book value in 4.5, 5 years for a company which is already, is basically saying ITC, HUL, the works are, doubling in size, at least financial size, every 5 years. And that's certainly not on the caused by re-rating of land land values or something like that. Not that it would not contribute, but to me that would seem like massive expansion of capacities and new factories, installations, etc. So this is definitely interesting. So going back to price to book value, price to earnings ratios, etc. If you're having that sort of ground level growth, then that's huge in terms of, and maybe that's the reason why these ratios are as high as they are, right? Okay, so I think basically that's it as far as the FMCG is concerned. We don't really, because of the limited back data that we have, really not much to say beyond this. And coming to the reports that Balki has put together as on 28th March 2015, 2016, right, Balki? I am also still in the last year sometimes.
Yeah, correct.
Okay. So essentially, ITC, HUL take up 66%, and if you add Britannia, that's 70% weightage. Right, so the top three take 70% weightage of this thing. So essentially that's what I was saying. ITC, Hindustan and Britannia, leave Britannia, just ITC and HUL are they growing at 30-40% growth in EPS? Book value growing at like 20% increase every year? That's a huge amount. Again, these are the ones which are going to be hit the most with things like Patanjali and Sri Ayurveda. So we'll have to see what the impact of that will be. So these are prices of the stocks as on 28 March. Should be more or less the same with the correction. And these are the targets, fundamental targets, approximately a year to year and a half from now. And if we look at it very quickly, ITC more or less has met the target, but there's also potential 10 to 20% upside on the highest level. Hindustan, the low target is 730, it's at 860 right now, so it's already in that range, about 10-15% upside. Britannia, okay, so this one is probably the 25 to 40% up, right? Godrej, more or less there. Dabur, more or less there. About 5 to 20% upside. United Spirits, that's a huge upside possible, but I don't know. Yeah, with this Malia thing still going on, does it have an impact on this company or not? I really don't know. Colgate, more 10-15% upside, and then what is this? Marico, or more or less that. So nothing much, I would say, except for probably Britannia and to some extent HUL and ITC. Okay. These are a number of reports, and Balki, what was the star for? These are the ones you found the best, right?
Yeah, correct.
Okay. Yeah, okay. So best in terms of what the reports were saying.
Yeah, best in terms of upside, possible upside.
Okay, fine, done. Okay, so essentially from that perspective, it's just ITC, Britannia, and United Spirits. So at least let's look at those top three first and see what, so ITC, HUL, Britannia. Okay. So we're looking at the chart of ITC right now, and essentially, you know, from 20 here 2006, 2007, 8, it basically stayed flat. Nothing much really happened, and it really started to take off after the 2008 move. And what you can essentially see is that from 80 rupees, right, the stock was 80 rupees in 2008-9. It has just taken off and has in the from 2009 to 2013-14, it's reached about 400 bucks, and after that really gone sideways in a consolidation over the last 3 years, 2013 to now, and really not you know, done much in terms of price. Remember, with almost 50% weightage, we're basically saying all those FA ratios are on account of ITC's behavior. So two things. One is it's become, you know, I would say, I don't know, but speculating that historically expensive from a fundamental perspective, and from things like EPS growth, looks like it's had a hit in between. So 13, 14 continued to go up 380 to 580, but something happened, and perhaps that's the reason why this is going sideways. Also recently, all the cigarette companies have stopped production. Some tiff with the government about they don't want to print larger ads about smoking causes cancer and all that stuff. So anyhow, so clearly I don't think there is any reason to be in ITC at this point. More or less range bound around 290, 300, technically speaking, would perhaps be a place to buy. This big volume that you're seeing here was on the budget day. They increased some tax, and then again, as usual, there's something on tobacco and cigarettes. it bounced back and then has been consolidating. Definitely, I would say some this sort of huge buying at lower levels is in the volumes that we are seeing is mostly institutional. So I think from a longer term perspective, yes, there seem to be some strong buyers at around the 300 mark, and if anybody is looking to have it in your portfolio, then put an alert around 300, and if it comes there, unlikely to go below that at this point, right? But on the other hand, really no compelling reason to think that it is going to go up quickly. This is the weekly chart of ITC, and if I put a weekly, that's the downtrend that is there. And well, simple, till that gets broken out, one should really be a little circumspect. Okay. Yep. So that's ITC. The Unilever. All right. So this is Hindustan Unilever, and again, whenever I look at HUL, so I can't help but mention that if you look at this in 2000, it was 300 rupees. In 2006, it was 300 rupees. In 2009, it was 300 rupees. So a multi-year, triple top. In 2010, it broke out, came back, and then again broke out in 2011. And from 300, it went to 1,000 rupees over the next 3 years. So it tripled over 3 years, right? So from 2000 to 2010, 10 years, essentially it made no wealth in a sense, okay? Of course, depending on your reference point. I'm taking 300 rupees as a reference point. If you take 100 rupees as a reference point in 2004, then already you've made 3x wealth by 2010. But in 2010, 2011, it breaks out, okay? Again, not great, nothing great in volume, just to note, but a triple top multi-year breakout and then goes up 3 times in the next 3-4 years, right? I think it's a extremely good lesson to keep in mind as to what can happen with some excellent technical setups like this and a good company. And at around this time, just to talk about fundamentals, this company had sort of transformed itself from made its number of products, brands, sub-brands smaller, more focused, more efficient, more aggressive marketing, all that, and was regaining market share and all that stuff. So whether you knew that or not, just to come back to technicals, then having the patience to hold and to know that, just wait. Of course, you don't know till where it will go, but it did, right? So, yeah, so technically, that's the story, and not many stocks like that, but when you do find it from a technical perspective, worth investigating fundamentally and then seeing what you want to do with that. Okay, so it went to about 1,000 rupees, right? So that was its life high at around 965, has come down to 780, right, thereabouts, and seems to have put a nice double or a triple bottom at 780, 790, and then is headed up again. Nothing great on volumes, unfortunately. This is the weekly chart, remember, but 780 definitely seems to be a good place to enter, and from 780 to 1,000 is about 20% upside that is possible, right? Britannia, so this was another much better than ITC or HUL. 100 rupees stock, 2003 became 2,700 rupees. One sure nobody ever visualized that. Okay, and again, so this is daily chart. I was looking at weekly before that. Let me just change that to Okay. So if we zoom in, just like HUL seems to have put a nice double bottom, almost like a tweezer's bottom, though not exactly. Right, so that's where we are. And around 2500 psychological mark seems to be the level that it has um, put up a nice base. Again, you can notice here price going up on high volume, again big volume selling, some settling down, and then clearly here in this part, which is March onwards, it's come down on clearly low volumes and then again been picked up on higher volumes. If I were to just extrapolate this downtrend line and try and put a best fit, that's the line I would perhaps keep in mind. And definitely seems to have found a base around 2.5 would probably be a good idea. Right now, all those moving averages which are on top are going to provide quite a bit of resistance. But possibly that this downtrend is over, and we might see a move up. But I think in all cases of the three charts we've seen, you need to see evidence of that up move with volumes on a breakout, breaking that downtrend line, etc., before you actually enter. Because fundamentally, again, coming back to all these ratios, there's really no, I don't see these valuations as being cheap at all, right? So there's no fundamental compulsion to get in right now, which makes it, from a portfolio perspective, I would say medium risk buys, and you want as low a risk as possible. So the only low risk that I can see is technically, definitely no, it's not low risk fundamentally. So why would I want to be in a hurry to get in, right? So that's it about these three, right? Anyone wants to add anything, any comments, any opinions? Feel free to add it up. Anyone?
Musa, so are you saying from a portfolio perspective it is not attractive
I don't think so, because
at current price?
yeah, because the only reasons to pick it up are from a technical perspective, and none of these technical levels that I see are long-term supports or levels to get in on any of them, right? And except maybe for ITC at 300 over a 3-year period. And I think, like as we already discussed in the beginning of the session, the risks to this space have increased because of all these new competition. So I am not looking at this as something as a low risk investment right now. So the reason, just to reiterate, one, competition to all these big chaps, the expensiveness which I think is there in the fundamental side, though we don't have enough back data, but something just on a P ratio of 50 or even 35 is really expensive, according to me, right? And then again, the price to book value ratio in 11, 12, to me it's expensive. So fundamentally, on the ratio side, we are expensive, in my opinion, and on the technical side, we are not at any particular multi-year support except for maybe ITC, right? So why would I want these right now? Plus, you add the issue of famine and rural growth and all. I see more negatives than positives. Any alternate opinion? Most welcome. Let's discuss that. Anything else?
No, not from me.
All right. Okay. So yeah, so this was the FA review for the FMCG index. We will close the session here. Please get back with your feedback. And so what we're going to do next is probably, I think since we've finished most of the sectors or all the sectors, we'll make sure of that. Just we'll go into sort of consolidating all this together and take it to the next level of comparing the sectors. We didn't do inter-sector comparison, and then once we've done that, then we will try and look at finding the, in quotes, better picks, lower risk picks, and see what sort of portfolios we can build, right? All right, so thank you for watching and look forward to having you on the next session.